friction was unacceptable to me. That because my friends, the salespeople, the people that are my customers, everyone was suffering from that. You're all suffering from it, right? When you go to an enterprise and say, I want to work with you, and they go, okay, well, here's all the stuff we have to go through to get to value. So I'm the kind of founder where the problem came first, not the idea for a company. And then we realized that problem had to be a separate company. It couldn't be done in the company that had acquired my first one because it needed to be neutral. So this owner of that company and I, he put in some of the seed money, the original pre-seed money, we would call it, himself, and he was a silent partner, and we went and built out and got our first few customers, and then several years in, realized that venture made sense for us because we're building a network, and in a network model, you have to have the nodes on the network before you have value. So we had to invest a lot of money to build plugins to systems like CargoWise, like Descartes, like Magaya, before we were attractive to anyone else. And so having that money and then turning that into an annuity, which is really what SaaS companies are when you have good net revenue retention, that was the model, and that's kind of what led us to realize that raising money for this one made sense.
And as a venture investor that's been kind of investing around the space, one of the areas that 10 years ago, I think was really kind of the moment where we said, hey, maybe we start dedicating more fund dollars to the theme overall. It wasn't exactly something that happened overnight. I remember sitting down, we had a number of conversations with a few Fortune 500 supply chain folks, and they would generally outline to us some of the pain points that they were dealing with, but they were constantly kind of coming to the same viewpoint of, we can't trust something that's so mission critical to early stage startups in an ecosystem where we don't know if they're going to be around 12, 24, 36 months, let alone 10 years. And at the time, it kind of gave us this pause of saying, hey, is there going to be enough velocity to exist here to scale early stage companies into something really, really meaningful? And I think it was sometime around like 2014 or so timeframe where Amazon's in the news on the Wall Street Journal every day with a new initiative that's going on. And I think suddenly we were starting to see the directive was starting to come top down more from board level discussion around, hey, is our supply chain an asset of our business or is it a liability of our business? And I think that frame shift of thinking, started to point more opportunity for early stage companies to kind of find their own footing in that new world. I think we've always had an appreciation for the fact that in supply chain technology, the digital world and the physical world very much converge. The supply chains touch really every industry of consequence, so size is certainly, quite there. And I think, in the realm of politics, I've always had an appreciation for city governments because mayors are responsible for getting your trash picked up and taking care of city services. And I think in the supply chain world, very operationally focused. It's very results-oriented field overall. And so I think a lot of that has generally crafted how we've approached and how we've generally thought about the types of investments that we want to make. And we can talk a little bit more about us coming into the picture on Chain, but we tend to gravitate towards companies where there's, I don't know if I'd say a lock-in effect, but once you've landed a customer, it should theoretically become a customer for life. And there are certain segments, within technology, especially down at the infrastructure layer, where you start to see some of those characteristics of customers you can grow with, customers you can keep for a very prolonged period of time. And those are characteristics that we tend to find ourselves looking for in companies. And you don't find them every day. And when you do, they're usually interesting opportunities.
Yeah, I think that actually ties to, and I know we were going to get into some of the nitty gritty here. So
sure.
That ties to when we went to raise our Series A. So we did a seed. We had several investors on the cap table for the seed, very, very good funds. And when we decided we decided when we raised the seed that eventually there would be an A. It was never going to be a one and done. And the conversation about raising the A really started the day after you raised the seed. Right? You started talking about what metrics are we going to need, kind of what's going to be expected. And actually, one of my regrets in the journey was that conversation actually should have started before the seed. That I wish I had actually spent more time with the seed investors, asking them what they thought we should look like for an A, so that I would know we were on the same page. And it turned out we were, but what we ended up having to do, the 90 days before we went out to raise, were extremely stressful for me, because I realized we hadn't gone deep enough in agreements of like exactly how should the P&L look, right? What do we want the gross margin to look like? And when I say to look like, there's a lot of interpretation that goes into how you want your financials to be presented in your head, right? That are honest and clearly within GAAP accounting, but this person's in this department, and we never really cared about like when you raise your seeds, you don't really think about like how is my P&L structured. But when you go to raise that A is when you start having real financial conversations with the investors, because there's a real business there. And we had to cram. It was a very stressful 2 to 3 months of me having really heated conversations with our board members that weren't moving the business forward, but were very much about that stuff. And so one of the things that I learned was start that conversation as early as possible, even though it seems like a waste of time when you're just trying to get something going. But understanding how it's going to look for the next round and the round after can save you so much time when you get there.
Yeah, and one of the things that we have in board discussions all the time, though, is the healthy tension around overly managing yourself to what you think others are going to assess and look at. If there's one thing that's very much happened over the last decade is enterprise software has transitioned from being more of an art to a science in terms of the venture landscape, because it has become more well-defined. You can go and Google anything you want, and you can say, what should I have for my Series B metrics? And I won't name the firms, but they've put out sort of like general guidelines, and all of a sudden I think it's crept into a lot of founders' minds, like, okay, I have to hit this, and I have to hit this, and I have to hit this. Overall, and Brian will oftentimes remind us that a network business doesn't look like this exact same thing as a vertical, software workflow application might look. And so you have to assess these slightly differently overall. I will say, though, that I met Brian at Manifest 2 years ago. So if you're wondering, is there value to coming these things and meeting future investors? Well, this is kind of a case in point. It happened. I think I'd seen him speak a couple times before. He's kind of been on the circuit on the supply chain side for a number of years. And then I was chatting with Sarah Barnes-Humphrey from Let's Talk Supply Chain. She said, hey, why don't you meet Brian? Turns out Brian's investors in his company from the seed round are a couple investors I knew really well. So it's very open and friendly conversation to get from the very beginning. What Brian was describing of trying to quickly assemble the plane as he was flying it behind the scenes leading up to the Series A. And the perspective that I got was he must have done something decently well at that point, because he portrayed a very mature business that had answers to a lot of questions and diligence items and data room items that were easy to assess. I mean, one of the things that we do is we go through a company's full ARR roster and we look at every single customer and we ask about those questions and which ones are expanding and how are those relationships going and everything. And I felt as though we had a really good dialogue from the beginning. It's easier to have a case study or a case for investment with my investment committee where the rapport is strong, the answers are forthcoming, and thematically and thesis-wise, there's a really strong alignment and fit. So I thought, we saw that from the beginning.
And one of the things I did behind the scenes was Mercury Fund, who's one of our seed investors who also participated in the A. I had a really honest conversation with them. Probably, let's see, when we raised it in the first quarter, right? So 22. So early summer of 21, we had a really honest conversation where I said, here, let me send you what I would send you. Would you fund this business for an A? And he said, absolutely not. They go, no, what I sent them, the business was fine, but the way I presented it was garbage, right? Because I didn't understand that seed is about storytelling and A is about starting to show the metrics, and then the conversation we have now is about how B is just all metrics, or mostly metrics at that point. But I had to go through that process with my investors and it was not pleasant, right? But it was very much worth it, because the outcome of that process was we were able to get 4 term sheets to land on the same day in that first quarter of 22, and that's when the pressure comes off. You go, okay, we did it, but the doing it was really a partnership with my seed investors, and not me just going out and raising another round. Everyone we talked to, with the exception of one, was introduced by one of our seed investors. I consider Chris in that bucket because those relationships already existed. So, I very much relied on my seed investors to help me raise that equity.
So you ended up with 4 term sheets. Talk a little bit about what that conversation looked like internally in the boardroom around selecting which one to go with.
So we were in a very nice situation of actually liking all 4 funds. And the term sheets came in, in a reasonable range of each other on valuation and amount, and they were, there was some spread, but and we actually did not take the best valuation, and there was a lot of conversation about who do we want to work with and who's going to understand what the business needs to look like. Because like Chris said, building a network business, or someone who's building a marketplace business, is not the same thing as building just a vertical SaaS platform, right? So, for instance, in our business, the onboarding and services cost on the front end is relatively high, but we actually run it probably a higher gross margin on the pure SaaS than most. Right, but in an early stage, you have a lot more services than you do SaaS, and so making sure that we had partners at the table who understood the vision, and one of the things that I'm actually kind of proud of that I've always done is I'm very, very upfront, and you won't be shy about that, but very upfront in first meetings with investors to say this is the vision of what we're building, and I try to listen for the ones who say, oh, that's great, I want you to be this company. And if I could bend you to be that company, it'll be great. Like that wouldn't make me happy. And so we scare those people off quickly. But so when we got to the 4, we felt good about all 4 because we wouldn't have gone through the process. The ultimate decision came down to a combination of who do we want to spend the next, better part of a decade in rooms with? Like, who do I want to sit in a board meeting with? Who am I going to enjoy coming up on the stage with? Like, that really matters because, and especially in the way I played out in my head was when we have bad days, who am I going to be comfortable calling, right? Like, who's going to be supportive? Who's going to actually have rational conversations? And we never raised that on the West Coast because a lot of the funds that I met out on the West Coast, I got the sense that if we had bad days, they were either going to yell at us or they were just going to write us off as one of their losses, and that was going to be the end of it. And then when the downturn happened, that all proved itself very well. I mean, we had, like every start, we had very, very tough conversations in the last 18 months, but they were always productive and they always had kind of a good outcome. And that was much, much more important to us than the little bit of valuation, because if we do this right, we're all going to make a lot of money. And I'll make a lot of money, and that little bit around the edges is not really going to change my lifestyle in 20 years. So how I spend the next decade and who I spent it with is really important to me.
Maybe I don't know if this falls in the bucket of advice or, just me pontificating about this a little bit, but I do find that sometimes, people get a little bit overly captivated in the strategic value, or this investor can introduce me to this person. And I think that's great. I think that's table stakes in many ways. What we do with our companies is we oftentimes lay that out, at the term sheet or before the term sheet. We start making introductions early on. We don't need to be investors to do that. But what I find is that people who operate in that manner, they're very transactional, and you get most of that value in the first 60 days. I've been a venture investor in my firm for 13 years, and I still have portfolio companies from my first year. And that's a long road ahead. And you really want those types of people that can be your cheerleader, your supporter, your therapist. I've got a couple founders that take to calling me on Saturday mornings just to tell me about what's on their mind, and they're some of the best conversations that I have. And I do remember, Brian, you did a reference call with Craig Fuller from Freightways, if you know the company. You led the seed round. I'm on the board of that company overall. And, Craig tends to be very outward in his own thinking as to, who he's worked with that he enjoys doing so. And I think he gave a positive reference on us. I hope he did.
We're here, aren't we?
Yeah, there you go. And I think a lot of this is at the end of the day, it's a relationship business, and you just want to be a good person. You want to be somebody that really takes the time to know somebody's business, and that they're not educating you in the board meeting every couple months, and you know their customers and partners and everything as much as you possibly can, and really provide thoughtful guidance where you add something, and then maybe swallowing your opinions where you don't add anything. And I think that's a big part of the business.
The interesting kind of manifest thing, tie back here. Tonight or tomorrow night, one of these nights, I'm having dinner with one of the funds that wrote a term sheet that we didn't take. And I have a very, very good personal relationship with them still. And that's so important because they might do our bid, right? You never know. Or they know somebody, 90% of the reference calls are not the official reference calls, right? They're this person saying, hey, I see that you're connected on LinkedIn to this guy, right? And, that, what I did with that fund, and it was uncomfortable. I did a full postmortem breakdown with their partners of why we didn't pick them, right? They asked to do it, and that was they're hard conversations because you're telling somebody why you're breaking up with them, but it was helpful to them to hear, in that case, I felt like, they were actually really wanted us to be a stage ahead of where we were, and they were trying to squeeze us into, they really wanted us to be a B company, and we were an A company, and I was like, 90 days from now, you're going to come to our first board meetings and ask why we're not behaving as a B company when we're an A company, and I don't want to have that tension. Just come back and let's do this when we're all together at the right stage. But doing that extra time, spending that time with investors, they all know each other. You see them all shaking hands here, right? And it very much matters to build those relationships.
So I know we're kind of coming up on time. I think we got a couple more minutes, but before I get into this next one, I'll just say discount whatever we say by 50% because there's no hard and fast rules or advice around this stuff. What works for one company doesn't work for another, and vice versa. But I'm curious, Brian, having gone through this, and maybe it would be a little different experience if you were going through this today versus early 2022. But any pieces of advice or things you would have done differently, having gone through raising a Series A?
I think, the outcome is good for us. So it's kind of hard, sometimes hard to think about what to do differently. I think that if there's anything that we didn't do a good enough job of, it was, again, really that conversation about, what specifically are we going to do on the downside? How do you feel about the downside of the business? Because then we hit, we raised the money and it was weeks after the money went in the bank that all the valuations went down and suddenly everybody was upside down and we were the most recent investment in the portfolio, right? And having those open conversations and figuring out whether you can have those during the, maybe not day first meeting, but as you're going through that process is a really good filtering process. I think we do have a couple minutes. I think we want to see. Does anyone have any questions?
Yes, that's what I was actually getting the microphone.
Okay.
So, is anybody having any questions? Maybe you can introduce yourself, who you are, from whom you.
Hi everybody, I'm Dario from Beardy.next. We're building visibility for Mexican companies. And I have a question. You mentioned that in seed investment, it's all about storytelling. And I was just wondering if that storytelling goes more for the founders and actually the background, or more about your experience with the early stages of the product, or how you are interacting with the market, so on and so on.
I think it's about painting a picture of the future, right? You don't have anything yet, and everyone has to fill in the color of the story, right? And being able to, and I think it's all of the above, right? So it's being able to tell the story of who I am, who our team is, and where we're going to take this. And there's no numbers to support. So actually, we found, one of the great things in the seed round that I found as I went through, I've had hundreds of conversations. We were about to get a term sheet when the first lockdown happened, and the fund could not write it something without meeting us. And they were in another city, and it fell apart. And it took us a whole nother year after that to raise the seed. And what I found in that year was, for us, anyone who asked us what the TAM was did not understand supply chain. And it was like a qualifying thing, right? So if I had to tell a story that started with, this is what supply chain is and this is how things move, it was going to fail. So I needed to have partners where I could tell them the story of how we were going to take a legacy industry and bring it forward. And really it was a vision story. Whereas when I met Chris, it was, here's where we are in that journey and here's where we need help getting to the next step, which is a little less of a visionary story.
Yeah, I would just say too, Michael Arrington, who co-founded TechCrunch, has a saying of numbers always ruin a good story, which, you know, you think about getting to the Series A point, investors are trying to create an idea of slope in their head. Is this a steeply sloped business, or is this something that's a little bit more linear? And by the Series A, you finally have two data points. You have your seed and you have your Series A. Now you have two dots, and that's how you connect it. You connect the dots and you got a line. Now they have to start figuring out, okay, what does this look like ahead of this for the next round and thereafter? And so your business does transition from that storytelling to storytelling and a little bit of results, to then it starts to become more results. And then, you know, it's funny that TAM discussion comes back in like in the Series C or D, because then it starts to become how close to the ceiling are we in this business.
Counterpoint, there are lies, damn lies, and statistics, right? So your numbers tell a story. And you can tell a story in your numbers that shows the business you're going to be. So for us, again, we had this problem of gross margin on services was our worst number, right? We were losing money on the services business. And because of that, we showed the numbers when we talked through them. We built a story around how that was going to change and how our org chart was going to change and how that was the number we were focusing on, because we knew it was our weak spot, right? So you can, just because you're using numbers in an A doesn't mean you're a victim of those numbers. You can still take control of the narrative.
Any other questions in the room? Again, introduce yourself.
Hello, my name is Marcus Cooksey, founder of Duke AI. We're accelerating payments by removing the human element out of the workflow and doing it all with AI for accounts payable receivables. My question is, you mentioned the story around, I guess, the numbers around revenue and where you're going to be as a company. Oftentimes, I'm curious to know, what does that look like in terms of product, and what is the expectation in terms of product? Because typically, the way I understand it is you go to Series to C's to Series A. There's some product differentiation. What is the expectation around what that product should be? I don't know if I'm asking that to you, Chris, or what is that product needs to be in your vision, or is the story sufficient enough?
What I generally look for on that front, and I won't profess to be a huge product expert, but I like to see a quality roadmap that reinforces the message that's being carried in the fundraising side. I like to see something that reinforces the strengths around core components of the product that we think are differentiating. What I don't like to see is a company who says we have X product and it didn't sell, so now I'm going to build Y product and then Z product, and next thing you know, you start to go wider than maybe the company at that stage is ready to really support. So, I don't know if there's like one size, fits all around this, but I think, some of this is assessing just what the product and engineering culture is in the companies that we're backing. We usually like to see some degree of depth and quality, and that really being a big part of the culture of the company, because we've seen a lot of businesses that are entirely go-to-market focused that maybe fall short eventually at some point because, the product roadmap just wasn't strong enough. They weren't delivering, they weren't shipping enough code, they weren't sort of delivering against product expectations. It's kind of general.
I don't really want to add much, because if there's anything that's different between raising in 2022 and raising in 2024, it's in that heated market of when we were raising, we didn't need to give these guys the opportunity to go too deep. Like it was because we were able to have these 4 funds and we set the timeline. And actually, one of the tricks we used, we never said we were racing. And it was like kind of we just went out, to people in the network and said, hey, you know, we're not raising, but we've had some interest. And do you want to have a conversation? So that we never put a date on it, right? And it wasn't like, you know, this. And then we managed that. It's a sales process, right? We would never go to a customer and be like, we want to sell to you on August 3rd. Right? Like, that's not how you start a conversation with a customer. So we started with, hey, you know, I'd like to pick your brain on something, or you know, we're thinking about maybe raising, can I talk? And we built those relationships up. But the big difference, I think, then versus now was these guys were looking at a lot more deals probably, and it was, and I know for us, we weren't getting the questions that I'm sure people are getting today, like as a team.
I would say we're looking at a lot more now than we were then, because I think part of that is just you know, people are kissing more frogs in this environment. They have to talk to more investors. As a result, every investor is seeing a lot more. They have more visibility into the market than they did a couple of years ago.
Yeah, we used a bit of FOMO in doing our process.
It worked. I think I gave him a timeline. He didn't give me a timeline.
Thank you very much.